Welcome to Making Your Miles Count Production, an educational program to all Canadian lease owner-operators with your host, Robert Scheper.
Okay, Making Your Miles Count. The Incorporation chapter, Chapter 5, is a little bit different. In the business world, you got self-employed, you got incorporation, and what we're going to be talking about is incorporation. None of us are lawyers. But if anybody wants any detailed stuff, on our website, I have about a 2.25 or 2.5 hour seminar on on everything that we're doing. It's just an audio, and in there I actually interview a lawyer who is now actually a federal judge, but I'm talking about pretty much what we're talking about right now. And incorporation it's a relatively new concept. It started, I actually don't know the exact date, but it's somewhere in the 1800s. The first, they've always had incorporations, but when it comes to separating liability issues, the first person who actually it affected liability issues was a man by the name of Aaron Solomon. And what happened was he had a business venture, or he opened a corporation. He had a business venture. He invested some of his own cash into the corporation, and he received what's called a debenture. The corporation owed him that money. It's a debt. And then he operated the business over a series of time, however long it took. The actual venture itself failed, and there was only limited funds left over. And so the creditors all lined up to get paid, and Mr. Solomon actually said, hey, wait a minute, I'm a creditor too. So he got in line. Mm-hmm. And of course, this was the first time in history, and all the other creditor goes, what are you doing here? You own the corporation. Mm-hmm. But it went before a judge, and the judge said, you know what, he is a creditor. And his requests or his debts was considered equal to the others.
Equal in standing.
Equal in standing. So that was the first real time where a corporation had liability issues that looked really kind of funny and limited in that area. But anyway, it all comes down to a corporation being a separate entity.
It's like an individual.
Yeah, it's like a person.
It's a paper person.
Paper person. You have a birth date.
Yeah.
You have things to keep it alive, and then you have, I guess, an ending, a death certificate, a dissolution, and it has to be considered separate from yourself. And it has its own GST number, its own business number, completely separate. When you're self-employed, your GST number is assigned to your social insurance number. And so if a person goes from self-employed to incorporation, you actually have to dissolve or cancel your personal GST number, the one that you've been using, and you start under a completely new, I guess, identity. The difficulty comes in actually understanding the operations of it. There are 6 separate hats that a person wears, or their hats to operate it. First is called there's the a first director. They have a shareholder, director, officer, and employee. Oh, so that's only 5. In the book, I go through in detail as to what the role for each one is. We'll maybe overview some of it. A first director, oftentimes if people incorporate themselves, they will be their own first director. They're basically saying, okay, we're going to do something here. We're going to create a separate entity. But it doesn't necessarily mean that you yourself can actually do it. There's actually law firms, a lot of law firms, they go out and they open up a half a dozen corporations, and whereas the individuals or the law firm is the first director. They've set everything all up, but it's really not alive yet. It does have a birth date, but it's not
functioning.
It's not fully operational. They call it what do they call it, shelf corporations. They just open a binder, put all of the relevant information and put it on there, and they wait for somebody to come along and say, I need a corporation, I need it right now. Well, they just take it right off the shelf and fill in the rest of the forms, and they go right into the second hat, I guess, so to speak. So it's ready, functional. Because the first director eventually, or very shortly, will actually step down as first director, and then the actual director will take over. Pretty much every law firm has these corporations in waiting.
Yeah, in waiting.
Waiting
that's right.
for them. And like, I'm trying to think. I don't know the answer to this question, but if it's on the shelf, when is the actual birth date, and when does Canada Revenue Agency actually decide when do you report any kind of earnings for? That's a good question. I actually don't know that question. But
well, if that corporation wouldn't be active, or it's active, but if it wasn't being used at the end of the year, let's say it wasn't used at all, would you just not a zero income?
Or you don't even have to report any kind of income because it's not active.
No, it is active, but it's not being used.
That's a good question.
Probably doesn't matter for this conversation.
Most shelves, most on the shelves, it's anywhere from 1 to 6 months before they start operating it anyway. There's no sense in them having hundreds of them up there for a very long period of time. But it is important to notice that there is the entire legal industry is going through dramatic changes, no different than the accounting industry. The accounting industry probably good 50 years ago, before everybody had a computer, the role of an accountant was very considerable. Everybody, needed an accountant because nobody knew how to fill it, or very few knew how to fill out an income tax form. But as the computers and software became more and more prevalent in society, now we can go to Costco and pick up TurboTax or whatever it is that they're selling, and it'll walk you through your own personal income tax return. And now the need for an accountant doing a personal income tax form has dropped very considerably. And it has not only affected personal income tax, but also corporate. If you know a little bit about what you're doing corporate-wise, you can it'll walk you through out corporately. It's probably T2 is a little bit more complicated. You can certainly do self-employed through there. A lot of people do that. But the whole aspect of technology has dramatically changed the accounting industry, but now it's also affecting the legal industry as well. And just in the incorporation process, if you would have looked, say, 30, 40 years ago, a very, very small percentage of corporations were opened by private individuals. It's almost always done by
lawyers.
Lawyers did everything in that regards. But nowadays, you can actually go online and open up your own corporation, and it costs you, $400 or $500, $600 or something like that, and it's relatively easy to do it. I know Ontario and Manitoba, approximately 50% of all corporations are opened by private individuals. The other half is through lawyers, which is dramatically different than it was historically, of course. But that means that if you have your own corporation, you don't have a lawyer, you are responsible for the minute book. And the minute book basically just records who's responsible for what and at when in that regards. If there is, we all own corporations here. If we are the only shareholders, the amount of risk that a minute book falling behind in paperwork is actually quite low, because there is no conflict other than external, like a lawsuit or something like that might play into it. But if everything is going normal, like in the trucking industry, an independent operator really doesn't need to incorporate for liability. That's the majority of reasons why people always incorporated, was liability. but there's so much, like the carrier carries, $10 million plus in liability insurance, and it transfers over to an independent operator who's on the company. So the probability of anything negative happening is so intensely low, it doesn't pay to be incorporated as an independent operator just for the sake of liability. It comes down to non-taxable benefits. That's the reason why and stuff like this. But let's go back. When it comes to setting up a corporation, we have provincial and federal. And a lot of people have asked, what is it better, provincial or federal? There are advantages, a little bit of advantages in one, a little bit of advantages, disadvantages in other. It's very similar. If I had a choice, I would pretty much always go provincial because long-term costs are just a little bit lower. And if all of a sudden somebody says, yes, I'm every couple of years or every 3 or 4 years, I move to a different province, might consider it then. But the advantage doesn't mean anything. If you have somebody in the province, let's say you choose, you incorporate in Ontario and you move out to Alberta, you can still operate that corporation just so long as there's somebody in Ontario that has a physical address that can have the power of attorney to make sure that everything is operating well. Whether it's a provincial or federal, the advantage of federal has to do with primarily where if you can buy land, for instance, only in the province. If you have a provincial corporation, you can only buy it in the province that it is. So if you have an Ontario corporation, you can only buy land in Ontario. You can't buy land in Alberta. But if you're a federal corporation, well, then you can in there. That's the only benefit. But as an independent operator, it doesn't affect you.
But if you would move, let's say, from Manitoba to Alberta, to transfer the corporation, it's not a lot of work.
To transfer the corporation,
like let's say I moved from Manitoba to Alberta,
and you have an existing, say, Manitoba
corporation in Manitoba, yeah.
And open an Alberta corporation?
No, like move the one from Manitoba to Alberta.
Your head office still has to be in Manitoba, and you'd have to have a power of attorney there in Manitoba, but you can operate it out of.
So you don't move the corporation, actually.
Yeah.
Okay. The corporation is a Manitoba Corp. That's where its head office is. If you wanted to operate and not have any connection to Manitoba, you'd have to dissolve the Manitoba Corporation and open up an Alberta Corporation, the way I understand it.
Yeah.
Okay.
Exactly.
And then operate out of Alberta.
And that's expensive. Well, I shouldn't say expensive. It's a lot of work for the accountant to move everything from one corporation to another. At face value, if you right now you buy a federal corporation, it's actually the dollar figure is $100 or $200 less to set up, but your annual fees are much higher. So if you're going to hold it for a few years or whatever, it's just going to cost you more. It's going to cost you more with a federal than a provincial.
Okay.
In there, so actually, when it really comes down to it, from a lease operator perspective, the vast majority of all the work in a corporation is done by the accountant. It's not done by the lawyer. The lawyer just stamp, sign here, you're done, and then they'll cash your check. That's pretty much it. Yeah. So transferring assets into, like your truck, into your corporation and stuff like that's all the work of the accountant. And I'd say probably 95% of the work is done by the accountant. In the future, I kind of suspect that there's going to be an awful lot of minute books that are just going to be digital in a cloud somewhere. Mm-hmm. That's where a lot of things are going paperless anyway. The old binder with stuff I don't think is of the future. I've been in a situation, I think 2 or 3 situations where one person lost the binder. One person, it got into a house fire and it burnt up. And the courts are totally okay with having to rebuild a minute book. because a minute book basically is sort of like the fingerprint to the history of everything in the corporation. Now, the only time it really becomes an issue of rebuilding or something like it, if there is a contention or contentious issue, some lawsuit or liability issue or something along that lines. It is rare to have them both happen at the same time. So don't worry about it if one guy lost it in a flood and the whole thing was completely all hamburger or whatever it was, so he had to rebuild the whole thing. And it may cost money, but
Can be done.
Can be done.
Yeah.
And the courts are totally okay with that. So anyway, first director is actually setting the thing up. And as I go in my book, the 5 different hats, there are different roles. There are different responsibilities. And the role and responsibility of the first director is actually completely different than a shareholder, which is the next role. A shareholder is completely just an owner. That's the only thing that an investor. That's all they have. A shareholder does not carry any liability. Mm-hmm. They're not responsible if the corporation does something illegal. Shareholder it says, "Oh well," and probably lost all of their money or something like that, but they are not liable for anything. They are just there to own the shares and actually elect the people who are going to be liable. So a shareholder comes together, and then they vote the next person. Let's stop here at a shareholder for just a minute, because this happens quite a bit. The big question is, let's say you're husband and wife. Okay, you and your wife own it. They're here, and they ask me. It says, "Do you want your spouse in the business or not?" They ask me. They should probably ask a lawyer, but I'll tell them what a lawyer would say. That is not a business question as much as it is a marital question, because in the event of a contentious, shareholder clash, from our perspective as an accountant, if it's a 50-50 split, it's almost like the entire corporation or all of the operations of the business, all the cash flow and everything can come to a complete halt. Yeah. Because the bank may
they're
not
equal in power.
They're equal in power,
and it can
and
be
so
at loggerheads.
yeah,
Right? It can just come to a stop.
You can't sell the truck.
Yeah.
You may not be able to write out a check.
Yeah.
It's a big power. So I generally recommend 51-49, but it's a general. There are a lot of marriages say, no, we're okay, 50-50. And hopefully they are okay, but it is a big area of contention. A lawyer will say that too, will say 51-49 is probably best. And what will happen from our firm anyway, if there is a marital split, we will say, okay, who owns the 51%? Mm-hmm. Because
they're the deciding.
They are deciding role. If you have 49% of a privately held corporation, your rights are very much
like
zero.
You had one or zero.
I have there's a story of a guy who had an insurance company out in the West, and he owned 49% of it, and there was a huge, I think a hailstorm or whatever, and they went through 2 years of solid insurance claims and stuff like this. Huge dollar figures rolling through the corporation. The guy who had owned 51%, he had control of the money and stuff like this. After 2 years, the guy who's been working like crazy, 49%. He says, "Okay, what's left over?" Well, there's nothing left over. And realistically, he ended up working 2 years. He got whatever his regular salary was, but there was no earnings whatsoever. The other guy benefited absolutely everything. It sounds nasty, and that's why it's extremely important to know who you're in partnership with.
But now I have this question. In a marriage, let's say your husband and wife, and you both drive, and something happens that the marriage is dissolved. wouldn't it be better to have it 50-50 than 49? Because I know of a case where it was that way, and she was left with nothing, and he ended up selling the truck. He ran away, moved to another country, and she was left here with the debt. Like if you're gonna go as a husband and wife, you're driving together. You're always working together. Like for us, I believe we're 50-50. I mean, there's no plans of any separation, because I keep telling my wife, if she leaves, I'm going with her, because I'm not staying home alone. But wouldn't it be better to be 50-50? Because that way nobody can cheat the other.
Nobody can cheat the other, but nobody, it can, like you said earlier, the banks can't listen to one or the other party, right? So it can actually tie up everything.
Yep. Yes.
Right? And so
it does.
Yeah.
When a divorce occurs, and especially if it's a contentious divorce, or even in a non-contentious divorce, you have weird, bizarre things that occur. I had one divorce. A client went through a divorce situation, and the husband was deeply hurt. Okay, there actually wasn't even infidelity in there, but he was deeply hurt, and he didn't want anything. He sold his truck. He sold his trailer. The money went into the corporation. He didn't take it at all. She just took all of the money out of there. And then he sold the truck, put the truck in there. She took all the money. After the debt was, so she ended up with absolutely everything, and he was so hurt, ticked off, whatever you want to say. He left her for another country, but he didn't take anything with him. So you have all sorts of different situations in there. And it does protect it when you're 50-50. It does protect the thing. But then what happens, generally speaking, in a divorce, and we should do a podcast just on divorce in trucking, because unfortunately I got way too much experience in it. But in that situation, that's when you get a lot of lawyers involved. And as soon as you get lawyers, you might as well just give everything you have away, and you both end up with nothing. Divorce is the leading cause of poverty, because especially with lawyers, it's pretty bad.
And the leading cause of wealth for lawyers, is that what you're going to say?
It's pretty bad. It's an area of advice. If at all questioned, and if you really don't know what you're doing, by all means, you get legal advice. And as long as there's unity in the husband and wife, and if she's okay with 49%, then so be it. There's one client that I had that the wife wanted 0 shares in the corporation, nothing, because I think deep down she didn't believe it was going to be successful or anything like that, and she didn't want anything to do. And she did. She was she had a career outside as well, and that has its own difficulties and unusual situations too, because when you're using non-taxable benefits, if you're both part of the corporation, both shareholders, the directors, and the like, what happens if she goes on the road with him for one trip every 2 months or something like that? She doesn't have to immediately collect a salary or anything like that, but she can be reimbursed for her job-related costs, because she is working technically for the company, so she can collect non-taxable benefits. When you're driving husband and wife, typically you do a certain set of stuff and she does a certain set of stuff, and if she drives,
and when she's driving, then you're doing the navigating.
You can split. I actually have get you 5 or 6 husband and wife
teams?
Where the but they don't. But the wife doesn't drive at all. They just
really?
go,
Yep.
Okay.
In there, but that's more of an insurance issue from the carrier than it is anything else in there. So a shareholder is just an owner, and what the shareholder responsibility is, they have to vote director. Now, a director, that is a hat that is worn, that associates liability with it, and that's where it's very important to to know what you're doing in there. There are only a few areas where a director can become legally and personally responsible if there's anything criminal, which is very, very rare. I don't know if I've even had any corporation do anything illegal. Not that I want to know sometimes either, but anyway. But probably the biggest liability in that a corporation has from a director's perspective is source deductions. Source deductions are classified legally as money in trust. And money in trust is the most protected form of currency or value in the free world. A lawyer, if you give $100,000 for a house to a lawyer or whatever, he puts it in a trust account. Yeah. And if he takes money out of there, $10 for a Tim Hortons or whatever, he can go to jail.
Yes, and they have.
There
was a lawyer in Steinbeck that went to jail for using trust money.
Yeah,
wow.
It probably happens all over. Now the Canada Revenue Agency states that source deductions are monies in trust. Now, if we take a look at how a person gets paid, let's say January 1st to 15th he drives, and let's say they get paid January 31st. Okay, let's say even a trucking company or whatever. January 31st they get paid. The date that it is supposed to be deposited into the employee's account is the date that all of the source deductions become monies in trust. Let's back it up 30 years when everybody wrote paychecks, physical paychecks, and let's say the check was January 31st, and the guy doesn't deposit it until January 2nd or 3rd or February 2nd or 3rd. The funds become the source deductions become monies in trust on January 31st, not on 2nd or 3rd.
Correct.
And which there has been issues, for instance, where people write out physical checks and then they drain the account on the 1st or whatever, knowing that it takes a couple of days to go through the checks. And the courts say, nope, the source deductions became liable exactly on the day it's supposed to be going into the becomes payable to the employee. And so though the source deductions not only are liable from the corporation becomes liable to pay them, but if they are not paid, technically, from a legal perspective, Canada Revenue Agency can say, okay, who's the director of this corporation, and okay, where does he bank? And I'm taking it out of his personal account.
The director becomes liable.
Yeah. We've actually had a situation where that actually occurred, and it was, it's super rare, but it does happen where the corporation was liable for source deductions, and they went into the personal account. Now, if I remember right, that particular situation, this was very rare. The person went through a bankruptcy, and the difficulty in bankruptcy was trustee in bankruptcy will declare, let's say the person bankrupt, let's say June 30th for simplicity's sake. We sometimes actually don't know the full liability of the source deductions on June 30th.
Correct.
It may be July, August, September.
Until you do all the accounting.
Until we do all of the accounting, finish off the year F to find out how much year-end, what's actually liable. When they declare bankruptcy, they have to declare all of the creditors, and CRA
is one of them.
Is one of them. If that number is wrong, if let's say they said, okay, he owes $10,000 to CRA, and it actually is $15,000, CRA can actually take the extra $5,000 and go after the corporation. So it's very, very critical in a bankruptcy process to not only have the right number, but sometimes even have it. This is a little bit of a problem for an accountant, and that is, let's say somebody says, okay, I give up, I'm going through bankruptcy. They don't necessarily tell us. Sometimes it could be 2-3 months later, we ever find out that, oh, this guy declared bankruptcy. Well, then maybe he should, because maybe he's embarrassed or whatever it is. And he said, well, then we better get these numbers to them. We get it together, and we would say it's, there was this particular case, I think it was $8,000 or $10,000 that he owed in source deductions on there. So we contact the trustee, and we say, okay, this is the number. He said, oh, well, he didn't tell us that he owed anything to Canada Revenue Agency. He said he didn't owe anything. And so they didn't have it on the document. So that $8,000 or $10,000 survived the bankruptcy.
Yeah.
And then after everything else, he still had to pay the debt on that. So it's very, very important that if you're going to go through a bankruptcy, and this isn't bankruptcy advice, but you have to include your accountant to do that. And if you go through bankruptcy and you don't have an accountant, oh my goodness sakes, you're upside down in your planning for the future for sure. It's really, really backwards. But anyway, so a director is somebody who is legally liable and handles all of the legal aspects of it. So when the shareholders elect a permanent director, you can be, first of all, you're the first director. You have one hat. And then you say, okay, I'm now also a shareholder. So you set up the paperwork, put all the shares together. You're now a shareholder. Now you got these two hats going at the same time. Then the shareholder then has a meeting and says, now we're going to elect a director. Yeah. And I elect myself. Yes. Or I nominate myself. I elect myself. Yeah. And so at one point, the person actually has three hats on. A first director, shareholder, and director. When you really look at it, it's a combination of comical, and it's a little bit hard to believe that one person can be three things, doing three things, but they're very, very specific in their roles and responsibilities. Right. And I don't know. That's it's very, very different. It's kind of like, let's say, a wife. A female can be a wife, a mother, and a worker. Very, very different worker. Whatever. Let's say an RN. Yeah. If they're registered nurse. They have three. Their thinking caps are completely different in each jurisdiction. Unless
all at the same time.
Unless they're dealing with their husband and a child, it's sometimes the same way. No. Anyway, so the three hats being a director, but as soon as the permanent director you actually throw away the first director, and now you only have shareholder and director. So now what's the shareholder basically goes to sleep, and now it's the responsibility of the director to, okay, now we're going to set things up. The first thing we need is probably a president. So let's look for a president. You put an ad on your refrigerator, and then you answer it. And so now you're a president. You elect yourself as president. So you're advising yourself as from a director position and a president. Well, what do? You negotiate maybe a salary. You negotiate maybe the responsibilities, and it's transferred over to president. And the president makes sure, for instance, that the corporation now buys a truck, gets a bank loan, sets up things, puts it all together. So that's what the role of a president. Sometimes a director can do stuff at the bank too, but depends on what the roles are. Make it as simple as possible for you. Now a president says, okay, we got a truck. We decided we are going to put it on at XYZ company, and now we need a driver. And so now, again, put another ad on the refrigerator, and you answer it. Then you, as a president, you interview yourself as the driver. And that's where you, as the driver, say, okay, I want to get this much as a salary, and I want to get non-taxable benefits. And if I use my personal vehicle, I want so much per kilometer for the use of your personal vehicle. And that's where the employer-employee agreement becomes. It's and then you set it up accordingly on there. So a person can be a shareholder, a director, an officer or a president, and also a driver. So you got four hats on, and an employee, and doing it all at the same time. But a lot of people, when they think of a corporation, they think of Ford Motor Company or Exxon or something, and it's really intimidating. You look at Royal Bank. Royal Bank, I think, has it's over 120, 150 directors for it, and that's ridiculous. Like, it's a different level of sophistication. They are a publicly held company, and a private company, which is what we're describing. A private company manages and has responsibilities. A publicly held company is completely different. Their responsibilities and their reporting is very, very different. And I'll leave that to somebody else who wants to explain that, because there's some things that they're responsible for I don't even know about. There's lots of things, depending what industry they're in and stuff like that. So now let's go. A corporation has its own income tax. It's called a T2. A personal income tax is a T1, and T2 is for the corporation. We recommend people incorporate and have their year end in the middle of the year. And there's a reason for it. Some of it is accounting, but some of it also is on practical decision-making situations. So it's sometimes, depending on the industry, it's much better to have it, say, New Year's or January 1st or something like that, like a calendar year. But that a little bit depends on the actual industry that you're in. I mean, if you're, you have a shop or something like that, has lots of employees, lots of inventory, and you handle Christmas rush and all these other things or whatever, and your inventory is the lowest, December 31st or something like that, it may make sense to have your year end January 1st.
But then you have to have inventory.
Yeah.
And you have to do an inventory, physical inventory.
Yeah, you were in an industry like that for 30 years.
Yes.
And so there,
it would have been better to have it on January 31st than
well, maybe, yeah,
or February 1st.
Yeah. So each one. But like a farm, it would be actually pretty normal. Yeah, December 1st or something like that.
Because you're not doing it
because you're don't want to say that farmers don't work in the winter time.
They work,
they work all the time. But definitely it makes a difference in some industries what time of year it is. But for the trucking industry, independent operators, if you have a June 30th year end, first of all, it takes, well, we can sometimes middle of July to end of July, we can the really, really quick guys, we can have their year ends done in July already. But the vast majority of them, it takes a couple of months before we get all of the paperwork and everything all finalized and stuff like this. Then you have a year-end meeting. So let's say you have a year-end meeting in October, and it shows that, okay, this is how much your T4 is going to be for the year, and as of June 30th, you have excess income in your corporation of, say, $10,000. What do you want to do with it? And so you can hem and haw. Maybe you want to do a bonus to yourself. Maybe you want to do a bonus to your wife. Or
maybe you want to leave it in the corporation.
Maybe you want to leave it in the corporation. A very small percentage leave it in there, but if there's a good solid reason for that, having that meeting beforehand and saying, okay, this is my plan. This is what you want. If, for instance, you want to do a bonus, and let's say you do $5,000 to the wife and $5,000 to the husband as a bonus, then you have to have source deductions that are associated with that. You can declare them as of June 30th, but then it actually comes to claiming them, and it gets a little time sensitive as to when you actually claim it. You can declare it on the 30th, but you claim it, say, you could claim it November, December, whatever it is. Typically, you would have the claim in December, and then what that means is that $10,000 has source deductions, say $2,000 in source deductions, and then the source deductions would be due January 15th, and that's the vast cycle of it. Now, if you don't have it on June 30th, let's say you have it on December 31st, all of these decisions are going to have to be made right in the middle of personal income tax season.
Mm-hmm. Yep.
And you're going, well, okay, what's personal? What's it? And sometimes it's actually too late. So let's say you say, okay, it's June 30th. Here we are in September, and we got $10,000. Let's claim $5,000 this year in the current year and $5,000 in the next year, because various reasons, whatever you want to do. If it's too close to the calendar year end, you don't have that freedom. Mm-hmm. You don't have that flexibility in there. So that's why June 30th is the most operative. If it's too early, then you can't bump it into next year. If it's too late, then whatever. So June 30th is okay. July 31st, yeah.
Smooth sailing.
That way, in a cycle, year after year after year, the first thing you're doing in fall, okay, we're going to be doing our corporate year end. We'll know what is due January 15th for source deductions, and we'll get that out of the way. Then we think about personal income taxes in springtime, March, April, May, and which is a completely different issue. Mm-hmm. And you get into that cycle: corporation first, then personal; corporation, then personal. And the more you understand the system, once you get through it, and you go, okay, this is how business is done long term. I want to make a mention about corporate taxes. I've interviewed hundreds, possibly thousands of independent operators in the last 20 years. And every now and then I get someone saying, oh yeah, my accountant is saving me taxes, I do dividends. And that is evidence to me that actually the accountant really doesn't know what he's doing. Because in the Income Tax Act, if you take a look at the whole big picture, and the Income Tax Act is extremely complicated, and there is no one accountant who knows everything on it, because there's all sorts of shades in every area. But on a general basis, if you take corporate taxes and then dividend taxes, it is designed so that it's the same as if you would have taken it out as income. That's the general rule on there. So if you pay $10,000 in a combination, like $2,000 or $1,000 for corporate taxes, and then $9,000 in dividend taxes, it's the same as getting a T4 with $10,000. And it's designed to be the same. The only real difference between utilizing corporate taxes and a T4, like through a bonus, has to do with delaying taxes to a future thing. They call it deferral, off into the future. Every province has its own corporate income tax rates. It ranges anywhere from about 9% to, I think, is 12.5% or 13% or something like that. And someone says, hey, my goodness, well, then let's go to the province that has 9%. It really, in the end, it doesn't make any difference, because if you're using corporate taxes, then you have dividend taxes, and if you're in the same province, the dividend taxes are too high, and it ends up being the exact same thing. So the reason why there are differences, it has to do primarily with other industries, like mining industries or something. Different provinces attract different industries with different tax rates and different factors in there. I know Ontario does a bunch of mining stuff. Alberta does oil stuff and stuff like this, and their corporate tax rate is based on what they want to attract and what they want to work with. So it's highly complex, and but all I'm saying is, don't worry about what your corporate tax rate is in the province. That shouldn't be a consideration for where you incorporate. Because in the end, it's all going to balance out to almost nothing. Maybe if you had, $200 million a year worth of income or something like that, that's when it maybe makes a little bit of difference or so. But as an independent operator, I'm just saying zero. It makes very, very little difference in that regards. But let's say, for instance, your corporation declares an income. That means that income has to stay in the corporation. Now, I've made a few assumptions in our firm. The first thing is that the vast majority of people, when they think about buying a truck and operating a truck, what they're doing is they're trying to increase their income. And by saying they're increasing their income, they want the money for themselves. And that assumption means, okay, the end goal is to have the corporation have zero income and zero value, which is great. Actually, 80% of all corporations in Canada show a zero income. Only 20% show any kind of corporate income, and kind of sounds funny, but I mean those are the stats on it. So realistically, from our firm's perspective, less than 5% of our clients work with dividends, like corporate income and dividends. The only time people use corporate taxes and dividends is when there's a specific reason for it. Like we've had some people, for instance, they want to save up money to buy a second truck. So or maybe there's some that there's one guy who wants to, a number of years back, save a bunch of money, and then he wanted to buy a duplex. And really all it does is it instead of paying, 30% taxes, they're only paying, say, somewhere around 10% taxes, and that 20% helps save up as a reserve to do something for it later. But ultimately, those are very rare situations, and maybe someday we'll do a podcast on passive versus active income. Because can a guy with his own highway tractor actually go out and buy a duplex and put it in there, and legally have active income? The answer is no, because it's passive. He doesn't have 5 employees. So anyway, that's a rabbit trail, but a very interesting topic. By the way, Canada is the only mixed up country that has those kind of active versus passive income. It is the most insane legislation I think Canada has ever passed. Maybe not, I don't know. The next question has to do with, should a corporation own a vehicle, or should the person own the vehicle? Now we have actually 2 examples here. Your corporation or corporations, your corporation owns a vehicle, and you have a corporation, but you personally own the vehicle.
Correct.
And from an accounting perspective, a lot has to do with the type of business that the corporation is actually doing. You do land development, you're landlord and all the bunch of other stuff. And you have to, on a daily basis, drive around to your different sites and different situations that you're going on. And you have to move things, and you have to get things, and you're supplying your sites for material, people, whatever it is. And so there's a real need to actually utilize it. Now, you could do a personal vehicle log. A little bit depends also on your resources and the like, and ease of use. Okay, you could put it all into the corporation, have it paid for everything. An independent operator drives one truck, and the need for travel that you don't use your truck for, absolutely you do need it. You have to go to the mail, you have to go to the bank, you have to go to the accountant, you have to go, pick up windshield washer fluid, you have to pick up parts, and sometimes move people around, that kind of thing. There is. But the actual daily need for that or even weekly need is actually very low. When we deal with auditors on a regular basis, they treat independent operators that need for that is actually quite low. I've even had one auditor say that, hey, wait a minute, if you bobtail your truck to go and do something, that's personal use. I can argue it, and I got it out of there, but that's how sometimes aggressive it is when it comes to personal travel, or what they deem to be personal travel. So it's a very different situation, both of them. I have had clients say, well, yeah, but I know a guy who put his SUV through his corporation. Well, sure. The accountant can do whatever he wants to do, but ultimately, is it going to survive an audit? What's all going to come of putting a vehicle in there? Whether it's a legitimate daily need, or whether it's a monthly or occasional need, there are rules that apply no matter what happens. If you need to keep a personal vehicle or a logbook on all of the miles that you travel, and what happens is, if you use the truck for personal use, okay, you get on your T4 at the end of the year a taxable benefit from having access to a corporate vehicle that's not yours. There's also something else, and this is it's a gray area, and some places in Canada it's really administered, some places it's not, and that's called standby charges. If you have a vehicle that is owned by a corporation and it's parked on your driveway, you can be legally liable for the benefit of it, even if you don't use it at all. And this standby charge, it's a wicked thing, and I have a podcast that deals a little bit with it. And it was enacted because there was an awful lot of car salesmen that were taking home brand new vehicles as demos, and they had use of it personally, just throwing on a dealer plate. And CRA says, wait a minute, these guys, every couple of months they get a brand new vehicle and they start driving it home back and forth, that kind of thing. And they said that's you're using it for personal, and it's a brand new vehicle. So they came out with this law that basically says, if you have a vehicle that a different like a corporation owns, and you're using it for personal use, a standby charges means that if you have the potential to use it for personal, or if you use it for personal, there is a very long formula that is applied to what a taxable benefit it would be attached to your T4, and it works out to 1/3 of the value of the vehicle. For instance, let's use simple numbers. The vehicle is worth, brand new, is worth $30,000, and the person puts a dealer plate on, goes home, parks it on his driveway just once in a year, and takes it home. They technically qualify for standby charges, so that at the end of the year, the dealership would put $10,000 on of additional taxable income on the person's T4, because it's approximately 1/3 of $30,000.
Wow.
That's a lot of money. First of all, so that you're looking at $3,000 or $4,000 worth of taxes just to have that thing parked on your driveway once. Okay, now that's an extreme case, but standby charges is actually there, and I actually have personal experience for this, because we did a lot of traveling with my old Jetta. This was probably about almost 20 years ago now. And it was 98, 99% of all of the travel had to do completely with business. And I went under audit, and they said, have you ever parked the thing on your driveway? Well, I said, well, yeah, sure. Sometimes I start from home and I go and I go out. And they said, okay, you qualify for standby charges. And what did you buy that vehicle for? Well, back then, I bought it for $10,000. All right. So you have $3,300 or something, whatever it was, $3,200 worth of taxable income, and your taxes are X amount of dollars on that. So I was charged that. And I said, well, then what do you do? And I says, and then the auditor actually said, well, you actually the best choice is for you to keep it personally and just charge your business cents per kilometer for the use of it.
Yep.
And so, I mean, it was an extreme case, but then when I looked through it, if you take a look at what the Treasury Board of Canada actually states, you can pay, an employer can pay an employee for the use of their personal vehicle. I looked through it, and the Jetta diesel at the time, I was getting like 8 cents a kilometer or something, 8 cents a mile was my cost for driving that thing. And I was allowed at that time, I think 35, 40 cents a kilometer. So I actually made after-tax money on it, totally legal. Another benefit, by the way, is if you own it personally and you get paid cents per kilometer, your corporation actually factors out the GST or HST in that bill. So if my corporation would pay me $100, they actually they expense $95, and $5 is input tax credit I get back from the Canada Revenue Agency. Or if it'd be in Ontario, it'd be 15 cents and 85. So it actually is a real benefit to have your vehicle outside of your corporation, unless it's such an extreme case like yourself, where there's high volume in there. Then it's bad. But you do have a risk factor. You have to have a taxable benefit of some sort on your T4 every year. And different accountants are going to give different numbers for that. Very much so. I had one guy said, well, my mechanic has a service truck and he takes it home every night. Well, there are actually very specific regulations with regards to that as well. If you have a business that has on-call service, you have to have documentation that you actually were on call and at what regular basis you are on call, how often you actually did go on call. So they can check out anything. There is so much auditability when a corporation owns a vehicle. It's just ridiculous. Just think about this from this regards. If you're driving around and you're handing in fuel receipts and maintenance and stuff like that, all of them are going into your corporation. Every fuel receipt has a date on it. It has how many liters did you buy, and a dollar figure, of course. Every maintenance has a date on it. So an auditor can actually recreate everything based on the receipts that you have. And if all of a sudden, you buy fuel in a particular city, and but then he says, well, okay, well, was that person even there? Then you can go into your logbook and find out, were you even there? And so he can check out anything and everything. There's so much information that you have to have everything absolutely perfect in there, and it's actually kind of risky doing that. When you get paid cents per kilometer, all you need is the date, why you used the vehicle, and the beginning and ending odometer.
But you don't need the receipt.
You don't need any receipts. No fuel, no maintenance, no lease payments, no nothing on there. If you have a lease on the vehicle or a bank loan or something like that, should all be done personally. And the only thing you should receive is your cents per kilometer remuneration for that. And it's a great system. It's a much more efficient system. It does require a little bit more interaction, because you have to actually state, beginning and ending odometer. And here's how loose it actually is. You could borrow your neighbor's car and go through it and come back and use a unique vehicle, and you could still get paid for it. The Canada Revenue Agency actually doesn't care what vehicle you actually use, if it's your neighbor's or a moped or anything. Okay, But the only sort of a caveat for that is if you drive more than 5,000 kilometers in a year, the rate actually changes. And so you actually get a little bit lower rate. So you have to keep track of that. So my wife and I, for instance, we have 3 vehicles, and occasionally we use one primarily for the business, but we also use the other ones because they're bigger units, and sometimes you got to haul things around and stuff like that. So you got to keep the track of the different units, and once they reach 5,000, then your rate actually changes, and that's all. It's all through regulation on there. So it is a little bit more work, but as long as a person understands the rules for it, it's really not bad. Like our firm, we have we do everything all online. You get a username and password. You go on there and you go to personal vehicle log. And if you set up with only one vehicle, then you use the same vehicle over and over again. And then once it gets to 5,000 kilometers, then the rate actually changes. You don't have to think about it or anything like that. You just do your daily entry or weekly or monthly entry into it, and it'll automatically do the calculations for it. So that makes it actually extremely easy.
But I can't use my semi to travel.
No, that is true. We receive personal vehicle logs that they said, "Oh no,
Yep.
we use the semi." Oh, call them up, and you can't do that.
Yep.
You know, that gets into a completely different realm for sure. But it has to be a personal vehicle, and it really doesn't make it matter what the vehicle is. I love the system, and I've known about it, like I said, for 20 years. I thought every independent operator should be using it. That was before I knew about per diem or non-taxable benefits, and but I said it was that feature in and of itself wasn't enough to incorporate. But anyway, all right. The next thing has to do with we talked a little bit about this, but in Canada, income splitting is actually illegal. If you actually say, "Oh, I'm doing income splitting," it's actually illegal. But you can effectively get very similar to income splitting when you, especially in a husband and wife team situation, if there's a bonus of $10,000. You as the management team can decide who gets what. Where Canada Revenue Agency doesn't like income splitting is when you have a whole bunch of people who aren't working and they start getting money, you know, your kids and stuff like that. That is is something that technically is illegal. You can pay your children to do some stuff. It's very limited. Canada Revenue Agency actually doesn't acknowledge children under the age of 12 as producing any type of value, unless it's very specific, like if it was a child model or something like that. That's different. But very much from an independent operator perspective, you can have children. Or like teenagers, clean your truck, wash your truck, and stuff like that. But it can't be, a tsunami amount of cash on there. A few $100s, you do have to have. It has to be reasonable, and you can't overpay them. And it has to basically be market rate that you're paying them. In there. But income splitting, technically, I don't want to use the word income splitting, but compensating people for their contribution in the corporation at a differing rate is actually totally okay. So let's say, for instance, your wife had a part-time job also. You don't want to split a bonus 50-50. She'll take 2,000 and you take 8,000. There's nothing wrong with doing things like that to be a little bit more efficient. But those types of stuff, like income splitting and stuff, those are minor details. They really don't save a huge dollar figure. By far the best thing that actually saves tax dollars is the non-taxable benefits. That's without a doubt the best feature in incorporation. Now, as you're going, every year you need to keep your corporation alive. You have to fill out all the forms to Canada Revenue Agency, but also you have to keep your annual fee for the corporation alive to keep it going. But to actually, you went through actually a dissolution where you dissolved your corporation.
Correct.
Where you sold your truck out of the corporation and you stopped driving for a while. And that is not a huge factor to dissolve it. I mean, you've signed a few $100, and it varies from province to province, but it's actually not that bad to actually dissolve it. Actually, again, the majority of the work is from the accountant's perspective to wrap up the GST, the source deductions to T4, everything like that. From the date of your dissolution, generally speaking, Canada Revenue Agency, let's say you dissolve it February 20th. You need to have all of the GST, the source deductions, all the returns in, I think for sure, all of the funds in by the 15th of the month following. So you have to have all of your P's and Q's all together, then you dissolve it, then you quickly get it all processed through. So anyway, that's pretty much the incorporation process and the like. Oh, wait, no, there's one more thing. And this is more, it's rare, but it does occur, and that has to do with holding company. Now, you have a holding company. You do not have a holding company. You're an independent operator, and we number of years ago we had somebody went to a lawyer, and they got they said, "Well, I buy a truck and I want to go through the incorporation process." And they came to us and they says, "Here's the two corporations." And they said, "What?" I said, "What? What do you mean?" He said, "Yeah, here's my trucking business, my independent operator trucking business, and here's my corporation that's a holding company." And I said, "Oh my goodness. The lawyer advised you to get a holding company for an independent operator business. That is..."
The lawyer made extra money.
Made a lot of money. And realistically, that
there was no benefit to the
no
individual.
benefit. We actually advised him to dissolve the holding company, and the like. And it's rare, but either the lawyer had no idea what he was doing, or he just did it for the money. Now, when you have multiple corporations, multiple different liabilities, multiple projects, I have a holding company. But that's because I have some property. I have one corporation that handles just the property, and I have a business and other ventures too. And the primary purpose of a holding company, and maybe a lawyer can fill in this if you really want to get more advice on a holding company, but sometimes there is, say, income to be dispersed. Let's say you want either whether it's a bonus or whether a bonus would be T4, but let's say dividends. You want to got some dividends at some corporations. Now, if I personally would receive dividends, or you would personally receive dividends, we have to pay dividend taxes on our personal income tax return. But let's say, for instance, we want the dividends, but we just want them so we can funnel them to do a different investment or something like that. We don't want to pay taxes. We don't want to use it personally because for whatever reason we don't need it. That's where a holding company comes in, where the holding company holds the shares of all of your investments, and so there's income from this one, and you can then disperse it to another without there being any tax implications. And that's the reason why there's a holding company. But if the primary reason you have a corporation is so that you can increase your income and you only have one truck and it's very simple, then you're not even working with dividends to start with.
Right.
And so a holding company helps absolutely nothing in there. It's only when you have income that you don't want to pay taxes on and you want to disperse in a different direction. That's the reason you have a holding
More for
company.
multiple businesses.
Yeah, for multiple businesses, for sure. Because sometimes probably the biggest factor of holding company also is, let's say, for instance, we would get into a partnership, and we have a corporation. You own, 30 shares. You own 30 shares, and I own 30 shares, and the business is doing okay, and it has income, and it pays dividends, and you want to declare the income and use the income personally, and so do you, but I don't. That way, if we do it with a holding company, then I don't have to declare it, and you guys can declare it. So if each one has their own holding company, it's another thing where you have a little bit more control with what you do.
So you wouldn't have to have a holding if, let's say, you have multiple trucks, like 3 trucks?
No, you can put them all in one corporation.
There's one business.
Yeah.
And it's doing the same thing.
Correct, but I know people that have had like 5 trucks, and one is not doing well, so they'll take from one and help the other.
Yeah, generally speaking, if you have one corporation, you have 5 trucks, all of the revenue gets deposited into one account.
Oh, I see. Okay.
And to split it off, maybe that's a good question, because it has to do with liability. A lot of people, when they say, "Oh, I'm going to incorporate," and so if all of a sudden I'm going to if the truck doesn't do well, it's all under a corporation. I can just walk away. The problem is, when you go out and buy or lease a truck, you personally guarantee, you personally sign for it, whether it's at a leasing company, bank, whatever. It's a personal guarantee. And so it doesn't make any difference whether you're self-employed or whether you're incorporated. They're going to come after you anyway. And there's a huge misunderstanding in the industry where people think, soon all I have to do is just incorporate, and then at some point in time, if I don't like it, I just walk away. No. I have never heard of anybody buying a truck, using debt, and not having to sign a personal guarantee. And as soon as you sign a personal guarantee with regards to that particular loan, it's flat out, it's going to come after you. They'll come after you, your jet ski, everything. What else you have?
You will pay.
The only time it doesn't. The only time it doesn't follow is when, let's say, you charge tires at a tire manufacturer, and on the invoice they mention your corporation and not your personal name. Then if something happens, then they go after the corporation. They can't go after you. But that very rarely happens.
And it's small dollars then.
And it's small dollars in there too, for sure.
Yeah.
All right, so that's it for incorporation.
Thanks for stopping by Making Your Miles Count. For further Making Your Miles Count productions, call us at 877-987-9787 or download us at makingyourmilescount.com.